Hello, traders. Gary Wagner here. It is 1:09 in Honolulu, 7:09 in New York on Friday. Happy Aloha Friday, as we say on the island. It is the 23rd day of September, 2022, and this is the Daily Report for Gold and Silver, our weekend review, and what a pivotal week it was. Today, traders witnessed a real tipping point from recent actions by the Federal Reserve as they have raised rates 5 times since March of this year, raising them from near zero to 3.5%, an action that was too little, too late. What we have seen is the dollar go to a new high over the last 20 years at 112.962. That is a net increase of 1.715 points or 1.54%. You can see on the daily chart, we have not seen this level in over 20 years. And when we look at our weekly chart, our Fibonacci extension is forecasting that the first point it might find resistance is about 115. And it was extreme dollar strength this week that led to the demise of gold prices breaking through a key and critical support level at 1680, trading lower today by almost $30, $29.40, basis the most active December contract, which is currently fixed at $1,651.70. I've just put up the Kitco Gold Index that shows changes in gold as it relates to dollar strength or weakness and normal changes due to trading. At the time I took the screen print, we had spot gold at $1,644. That was a decline of $27 on the day, with only $1.90 directly attributable to market participants selling gold. The vast majority of the decline today was due to dollar strength taking away $25.10 of today's $27 decline. Silver was also affected by extreme dollar strength, with the December contract losing almost 4% or 78 cents, and is currently fixed at $18.83.5. However, when you look at the Kitco Gold Index, what you see is the vast majority of today's sell-off, 48 cents of the sell-off, is directly attributable to selling pressure in the market, and only 29 cents of the 70-cent decline attributable to dollar strength. In other words, as far as silver goes, it was a combination, with the majority of the sell-off directly attributable to traders bidding silver prices lower. Obviously, dollar strength taking the precious metals lower today did stop us out of our long gold and silver trades. The exact numbers are on the member page under the proper action section. On today's weekend review, I want to have a different approach. Take a look back in history to how different members of the Federal Reserve handled high levels of inflation and brought them back to acceptable levels, how the dollar reacted at this point, and most importantly, the focus on our opening letter, and that is the one critical mistake that the Federal Reserve made by acting too late and believing that inflation was transitory, and really sat back as they watched inflation ratchet up in 2021. This is not the first occasion when the United States had the problem of addressing exceedingly high inflation. In fact, the highest level of inflation on record occurred at the end of the 70s and into the 80s. You can see that on this consumer price index. And by 1980, we saw inflation move from 6% up to 14% vis-a-vis the CPI. I have just put up not only the inflation index table, but how the Fed addressed it by raising rates. What we are looking at in this graph is both the real interest rates and inflation, with inflation coming in is a dashed line, that is this line right here, and the rate of interest rates rising as a solid line. You can see a very, very close correlation. As inflation rose to over 5%, the Federal Reserve addressed it by raising interest rates to approximately 5%. When we had our first real peak, the Fed was a little bit slow to act, but they slowly moved. And as we had this hard spike right around 78 to 1980, when inflation hit the highest level in history, just at about 14%, real interest rates were well above that. That being said, it was a multi-year process to take interest rates and inflation to acceptable levels. In other words, it was a multi-year process. When we look at inflation, and this is the average inflation of 79, that was 11.3%, then 13.5% in 80. Realize they are raising interest rates as this is occurring. In 1981, we went from only 13.5% to 10.3%, by 82 to 6.2%, and it wasn't until 1982 when the Federal Reserve, through aggressive rate hikes in a timely manner, brought inflation to a respectable level at 3.2%. In contrast to how we saw the Federal Reserve reduce inflation at a record 14% in the 80s, we are looking at a 12-month inflation rate beginning in January of 2020, going up to August 2022. The pandemic was in full swing in 1919 and really throughout the 1920s. But in January of 2021, we had a real interest rate that was still rather low. It was below 1.5%. By February and March, it was starting to rise, and by March of last year was approaching 2%. Because the Federal Reserve believed it was transitory, they did nothing. A month later, it went to 2.6. The Federal Reserve did nothing. 4.2%, 5%. In fact, by the time the Federal Reserve actually enacted its first rate hike, which is here in March of this year, inflation was already at an astounding 7.5%. Now, it is a known fact that historically speaking, you cannot reduce a level of inflation without matching interest rates to the current rate of inflation. The Fed has raised rates from near zero in March to its current rate of 3.5%. And 3.5% is a level in which it is not going to have any impact on inflation that is currently at 8.3%. In other words, what I'm trying to show is that the root cause of not only the level of inflation now, but the upcoming inevitable recession, which I believe will be deep and protracted, is because the Federal Reserve acted too late, because they incorrectly assumed and acted upon the assumption that inflationary pressures were transitory. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.